The current trading landscape for SLB NV, listed on the NYSE as SLB, reflects a market that is aggressively repricing its outlook on the energy services sector. As of Saturday, January 3, 2026, the stock market is closed. SLB finished its last active session on Friday, January 2, 2026, at a price of $40.20 USD. This represented a substantial upward move of 1.82 USD, or a 4.74% gain for the day. While the headline figure suggests a straightforward rally, the underlying mechanics reveal a sophisticated tug-of-war between institutional accumulation and retail sentiment. Most investors see a 4% jump and assume a simple recovery in crude prices, but the reality is far more complex. The true catalyst behind this specific move isn't just about the price of a barrel, it is a fundamental shift in how the market values SLB's transition from a traditional hardware provider to a high-margin digital powerhouse. The expectation in the broader market right now is that oil field services companies are tethered solely to the cyclical nature of drilling. Most people believe that if oil prices soften, companies like SLB will inevitably drag behind. However, the reality we're seeing in the data suggests that SLB is decoupling from that narrative. While competitors are still fighting for market share in traditional drilling rigs, SLB has quietly positioned itself as the operating system for the entire energy landscape. The recent jump to $40.20 USD was triggered not just by sector momentum, but by the market finally pricing in the long-term implications of their massive 5-year contract with Aramco for unconventional gas services and their strategic AI partnerships with major players like Shell. If you're looking at your Robinhood app or checking your individual brokerage account today, you're seeing a stock that is testing key resistance levels that haven't been touched in months. Common wisdom says that you should fear the capital expenditure cuts from big oil companies. The general belief is that as we enter 2026, the global surplus of oil will force producers to tighten their belts, leaving service providers like SLB out in the cold. I want to challenge that perspective. When you look deeper into the institutional activity, you see that the big money isn't fleeing, it's rotating. They aren't just buying SLB stock because they expect more wells to be drilled. They're buying it because SLB is becoming a data company. Their digital division is seeing double-digit growth, and their margins in that sector are significantly higher than in traditional reservoir performance. This is the classic gap between expectation and reality that creates opportunity. The market expects a cyclical laggard, but the reality is a tech-integrated infrastructure leader that is increasingly insulated from the raw volatility of the commodity it serves. If you're using tools like Schwab Intelligent Portfolios or exploring online investing platforms to build a long-term position, understanding this distinction is vital. In the most recent trading sessions, the volume for SLB has been remarkably robust, often exceeding the 3-month average of 15 million shares. This isn't just retail churn. We're seeing significant blocks of institutional buying, likely from managed funds and wealth management sectors that are seeking yield and stability in an otherwise volatile energy market. While the 52-week high sits around $44.66 USD, the current trajectory toward that level is backed by a shift in the company's business model that many self-investing individuals are still overlooking. They see the name Schlumberger and think of heavy machinery and steel pipes. They don't see the AI-driven autonomous operations that are now contributing over $600 million in quarterly revenue. Let's look at the immediate daily swings. The jump on January 2nd was a classic breakout. After hovering in the high 30s for several weeks, the push past $40.20 suggests that the psychological barrier has been broken. On the Fidelity trading platform, sentiment has shifted from neutral to bullish as the technical indicators align with the fundamental news of the Aramco deal. This deal specifically focuses on stimulation services for unconventional gas, which is a key growth area as the world looks for cleaner bridge fuels. When you invest online, you have to look for these specific catalysts that move the needle beyond just the general sector trend. SLB stock is currently outperforming its peers like Halliburton or Baker Hughes, and that spread is widening because SLB's footprint in the Middle East and international offshore markets is providing a buffer against the slowing growth of U.S. shale. Speaking of involvement, I want to hear from you. Comment below how many shares of SLB you currently hold, or if you're waiting for a specific price target to enter. It's always helpful to see where the community stands on these energy giants. To understand why SLB is moving the way it is, we have to look at what the company actually does today. Historically, SLB, formerly known as Schlumberger, was the undisputed king of oilfield services. They provided everything from seismic testing to well construction. Their business model was simple: provide the best tech to get oil out of the ground. But over the last few years, they have pivoted. They are now an energy technology company. This involves a heavy focus on digital integration, carbon capture, and even data center solutions. Yes, SLB is now providing services for the data centers that power the very AI everyone is talking about. This expansion into adjacent markets is why their revenue is projected to hit over $40 billion annually by the end of 2026. They are no longer just a picks and shovels play for the oil industry. They are the high-tech backbone of the global energy transition. The macroeconomic pressures are real, though. We cannot ignore that 2026 is expected to see an oil surplus, with some forecasts suggesting prices could dip into the 50s. This is the reality that the market is weighing against the expectation of continued growth. However, SLB's acquisition of ChampionX late in 2025 has already begun to pay dividends. This move gave them massive exposure to the production and recovery market, which is less sensitive to drilling cycles. When production is already online, companies need chemicals and artificial lift technologies to keep the oil flowing, and that is exactly what ChampionX provides. By integrating these services with their digital platform, SLB can offer a holistic solution that competitors simply can't match. This is why, even in a potential low-price environment for oil, SLB's cash flow remains incredibly strong, as evidenced by their recent free cash flow yield of around 9%. If you're using interactive brokers or other professional platforms to analyze the Greeks on SLB options, you'll see that the implied volatility has stayed relatively grounded despite the price move. This suggests that the market doesn't view this 4% jump as a speculative bubble, but rather a stable revaluation. This is a crucial point for anyone engaged in online investment. When a stock climbs on steady volume with low volatility, it often indicates a sustained trend rather than a short-term spike. The institutional owners, who hold a vast majority of the shares, are clearly comfortable with the current valuation, and many are actually adding to their positions. They see the same thing I'm seeing: a company that has successfully navigated the most difficult period for the energy sector and come out leaner, smarter, and more profitable. The future outlook for SLB is defined by several key catalysts. First, the upcoming earnings report on January 23, 2026 will be a major test. Analysts are looking for an EPS of $0.74 USD. If SLB can beat this, especially on the revenue side where they had a slight miss in the third quarter of 2025, we could see a push toward the $45 mark very quickly. Second, the continued expansion of their digital division is the real wild card. If they can continue to grow their digital revenue at double-digit rates, the market will likely start valuing them more like a software company than a drilling company, which would lead to a significant multiple expansion. This is the ultimate upside scenario. The risk, of course, is a total collapse in global energy demand or a geopolitical event that disrupts their international operations, particularly in the Middle East, which accounts for a huge portion of their growth. When you look at the landscape of investing sites and apps, from Fidelity Investments to the SoFi trading platform, the consensus is leaning heavily towards a strong buy. Out of nearly 30 analysts covering the stock, the vast majority are bullish, with price targets ranging from $45 as high as $58. But again, you have to balance this expectation with the reality of the market. The stock has been in a broad range for a long time, and it needs a sustained catalyst to truly break out of its multi-year consolidation. The 4.74% move we saw on Friday is a great start, but it's only the first step. For those who are self-investing, the key is to watch the $42 level. A clean break above that would confirm the bullish trend and likely lead to a new 52-week high. In terms of the competition, SLB is clearly the leader, while companies like Halliburton are more focused on the North American market, which has been stagnant. SLB's international exposure is its greatest strength. They're winning contracts in Saudi Arabia, Iraq, and the United Arab Emirates, where production costs are low and investment remains high. This geographical diversity is why SLB stock is often the preferred choice for wealth management professionals and those looking for stable energy exposure in their Fidelity mutual funds or IRAs. They aren't just betting on a single region, they're betting on the global energy infrastructure. This is a much safer play than betting on small domestic producers who are at the mercy of every minor fluctuation in the